Hey, what's up guys? It's Ezekiel Chiu here. So, you ever place a trade and it feels like the market is waiting for you, right? Just to slam your stop loss. Yeah, I mean, that is not a coincidence. That's design. What if I told you the market isn't random? It is rigged to punish retail traders who don't know what to look for. So today I'm going to show you exactly how the banks and the institutions move the markets using something called the order blocks. But this is not the watered down version that you see on YouTube, right? This is the real framework that the smart money uses, built on liquidity grabs, hidden imbalances, and precision entries that most traders never see coming. So if you are tired of being on the wrong side of the trade and you are ready to start trading with the sharks instead of like getting eaten by them, this video is your wake-up call. Let's go. Okay, so first off, what is an order block, right? An order block represents a supply or demand level, but not every supply or demand level qualifies as an order block. All right, so let me show you how. Every price level reaction leads to a formation of a supply or demand zone, right? So this indicates what? That the traders have execute large buying or selling orders at that area that leads to a strong price movement after which. So when price returns to these levels, this is what we're going to do. We're going to closely monitor price action to identify possible trading opportunities at those areas itself. So these are what? Area of value, right? Which are important areas. However, if you're going to trade every supply and demand area, this is not going to work out. This is not going to be effective over time itself, right? Because when you keep looking at all these chart patterns, you're going to notice that when supply and demand zones, when they align with specific conditions, the chances of success would increase significantly, right? But here's the catch, right? Not all supply and demand zones are order blocks, right? There are rules, all right? So now let's dive into those. Here are the 3 rules of a valid order block. Number 1, inefficiency. Number 2, breakouts. Number 3, liquidity. All right, so now let's kick off, right? We're going to look at what makes an order block valid for trading, right? Then I'm going to show you how to find them and mark these areas on the chart itself. All right, so now the first one, inefficiency. So what is it, right? Inefficiency, it occurs when the identification and the usage of it fail to achieve the desired trading results. Okay, this, oh my gosh, this is so difficult to understand. I'm going to show you. All right, so now, take a look at this. When a lot of money flows into the market itself, it creates an imbalance between the buyers and the sellers, leaving gaps between the candles itself. This phase shows inefficiency in price movement, right? These gaps on the chart, it signals what? That the players have stepped in and pushed the price in a certain direction. So what is going to happen? Price often would return to these areas to accumulate all the remaining orders, right, that were not filled at there, right, creating a trading opportunity. All right, so now price would take off after reaching the order blocks, but only if there are remaining orders still there. So now, as a result, here's what's going to happen. A supply or demand zone that form all these what we call fair value gaps becomes a key level, right? So when you are mapping the market structure, we always want to highlight fair value gaps on the chart itself, right? So this is the first rule in identifying a valid order block, right? So now, once the inefficiency is clear, we're gonna look for this second clue. Right? I'm gonna put all of them together, right? I'm gonna put all of them together, right? This is where it's gonna make a lot more sense as you go along, right? So the first one, inefficiency. Alright, number 2, breakouts. So if the market is in an uptrend, the market is bullish, right? So price is making higher highs, right? So when price is breaking the latest market structure, right, and closes above the previous highs, this is a uptrend, right? But so price goes up, comes down, it pulls back down, forms the point of origin for this big movement upwards, right? Before coming down, forms the point of origin for the next big move upwards. So all these points of origin are highly important areas. This indicates what? That the demand zone that is driving that movement upwards is not just any level, but a very crucial level within the market structure. Alright, so but that said, a supply or demand zone is recognized as a valid order block only when it leads to a structural break, like in this case, the break of structure. Right? If it goes up but it does not lead to a break of structure, that is not considered as a key demand area. Alright? So now the same concept would apply for a bearish scenario. Right? When price breaks the latest market structure to the downside, the origin of this movement is the highly significant level. Right? This confirms that the supply zone that is responsible for this move downwards is not just any level, but a key level within the market structure. Alright, so now you start to understand where are the key levels, right? Here, we're going to see what? A moving uptrend itself. Alright, this is the latest break of structure, right? Indicating what? That the demand remains in control. Okay, so now, all these demand zones are seen as potential opportunities to go short. But here's an important point. The origin of this bullish price movement is the crucial area, because this offers the best trading opportunities at that area itself. Point of origin. Alright? So now, here's what's going to happen, right? There's a good chance that many traders are going to get trapped in what we call a liquidity grab, right? So that's why it's important when you are trading at these areas, you want to don't just like, for example, oh, this is a key area, I'm going to go a higher risk percentage, etc. No. As per all trading itself, every trade should risk the standard amount of risk. Alright, now, before we go any further, this next rule is what separates the real setups from the fake setups. Number 3, liquidity. Alright? Liquidity is where the stop losses are placed in the market, right? Combining the concept of liquidity with order blocks are going to help us to understand the market movements better, right? And this allows us to make better decisions. Right, so now let's take a look at this. The first liquidity, what we call a liquidity grab pattern, happens when the fair value gap and the order block are located just below our demand area. Alright, so now this means what? That the first demand area is likely going to be taken out by a liquidity grab. Alright, so which means that price is going to grab that liquidity right below that area. Alright, so therefore, if you're going to place buy at the demand area, high likely, or I would say there's a good chance that it's not going to go up right away, but instead it's going to go down. So which is why a lot of traders would get stuck over there. Right, so therefore, we do not want to buy over there because there is an area of liquidity right below. Right, so therefore, you want to wait for it to drop down. When price reaches our order block zone, right? That is the area where you want to go, right? To execute your buying orders, right? Because that is your key crucial area itself before price taking off. All right. So now here's the thing. By understanding this alone, just understanding one thing, point of origin. Right? By understanding this alone, it will allow you to pinpoint certain areas that has higher probability of winning already just by this itself. But in order for you to understand why has that to be happen, you got to understand liquidity grabs, right? Liquidity grabs are always at all these fair value areas, etc. Right, below the demand zone, below equal lows, etc. As we can see over here. Right, so that's the reason why if you're going to enter at the demand area, it's likely that that may or may not work out, right? But sometimes it will work out, sometimes it doesn't. But why not only take trades, right, that has the highest chance of winning, which is at your next level below. That is your order block zone. All right, so now let me give you another example, right? So here we have a demand area, right? We have a demand area and a possible opportunity to go long. Now, if we look to the left, what happened before? We can see a gap between the candles itself, right? Sitting right below that demand zone. So this gap will attract price to go to that area and drawing it down to fill the imbalance, right? Collect the liquidity around the area itself, right? And then after hitting the order block below, which is our key demand area, before pushing price upwards. You get it? So here's the thing. We should always, before you identify a zone, right, you want to look at data on the left first before deciding whether your demand zone is going to be the good demand zone, or there could be actually a bigger key demand area below where price will likely break below the first demand, collect the liquidity before entering the key demand area and then bouncing off. All right, so now I'm going to combine them, right? Now you know the overall concept of order blocks. So let me show you how to effectively mark the order blocks or draw the order blocks in 3 ways. Quick pause. If you found this video helpful so far, here's something that always surprises me. 73% of you who watches this video regularly haven't subscribed yet. I mean, if you're getting value and want to support what we are doing, the best way is just to hit that subscribe button. It's free and really helps us to continue creating better content for you every single week. It truly means a whole lot to us. Okay, now let's get back to it. The first method is a normal bar. Identify the last candlestick, the last one before this sharp bullish move upwards. So it doesn't matter what color that bar is. All right, it can be red, it can be green, doesn't matter. Right, this candlestick represents and marks the decision-making zone where the buy orders are placed. So creating this order block. When price returns to this area again, that's where you can enter on a buy trade and set your stop loss below the zone itself. All right, so now vice versa for a downtrend, right? Or reversal downtrend, right? It's the same logic. You identify the last candlestick before this sharp bearish move downwards, right, as your order block zone, right? This is the basic way to mark order blocks on the chart itself, right? But in some cases, adjustments may be needed. All right, so here's the thing. Sometimes the candles that forms all these order blocks are not so straightforward, which is why I'm giving you 3 ways, right? The first way is the normal bar, which is what you have just learned. Now, the second one, bars with wicks, right? Or candles with wicks. All right, so sometimes a wick can grab the liquidity below the order block of the candlestick, right? So now this makes us want to add the wick to our zone. All right, so now you got the previous bar, right? Using the previous bar high, which is the bar before it shoots up, right? But now, because the following bar has a long wick, that's where you add the bottom of the wick to the top of the previous bar, creating this order block. So you only do this when the subsequent bar has a long wick. All right, but then the problem is that we would have a large order block to trade. Right, so that's why in situations like this, when price comes back down to the order block, you can, right, or you want to look for more confirmations, maybe like candlestick patterns, or even drop to the lower time frame, right, for better execution to trades at this order block zone. Okay, so now this is the second one. Let's move on to the third one. The third one is there are times whereby it's not a normal bar, it's not the bar, if not it's the subsequent bar with wicks. There are times whereby it is just a small breaking bar, a small bar before it shoots off. Right? So sometimes the candlestick that creates this order block is going to be very small. Right? And there's a chance that price will mitigate this zone and respect the low. But because the order block is so small, right? It's going to be pretty risky if you just place your stop loss right below this order block, right? So therefore, we can either set a wider stop loss or consider a broader zone on both sides itself. So now, here's the thing.
Ezekiel, how do I know that this candle that bricks offer is smaller than the average candlestick range itself?
If you see, I look on the last two bars beside me, it's the same size one, right? Okay, now, here's what you can do. You can add it or you can measure it by adding the ATR indicator. Alright, so the ATR indicator is the average true range indicator, right? That measures the market volatility. So it gives you the average size of, let's say if you set it as 14, the previous 14 candles. The default setting is 14, right? For the ATR indicator, right? So you just set it as 14, right? It gives you the average size of the last 14 candles, right? So now, let's say in this case, right? The ATR of the last 14 candles is 20 pips. So here's what you can do. If the order block, right? The range of order block in this case that we measure is only 12 pips. Then, and our average range is 20 pips. So here's what you should do, right? You can extend your order block zone to 20 pips. Because this bar is so small, it's risky, right? So you can extend the order blocks from 12 pips to 20 pips to create this safety net. So this gives price room to breathe while our stop loss is at a logical area. This will save us from all the fake outs. If your order block is too small, right? It's going to get a stop loss. So therefore, your order block is now bigger, your stop loss is at a safer place itself. Okay, so now we have covered the three methods, right? To set your order block, to draw your order block, right? In probably most of the scenarios out there. Now, if you realize what we have talked about so far, what if price reverse, say from uptrend to a downtrend? How do we now still use these order blocks itself? So continuation order blocks, continuation means what? Continue uptrend, right? Continuation order blocks happens when price is trending upwards, right? Or downwards, right? That is in line with the dominant trend, the big overall trend. So now, for example, let's say we got this uptrend with with a series of higher highs, right? And higher lows. So each of the demand zones order blocks form along the way, right? So it gives us an opportunity to retrace, to buy, to go along with this dominant uptrend, right? But now, let's say a change of character appears, right? It touches the lows, forms the lows, and then after it breaks below, right? A change of character from an uptrend to a downtrend happens. So now, what will happen? A supply order block will now form, right? At a point whereby it changed towards to the downtrend, right? It broke the low, right? With a change of character, correct? So now you got a supply order block over there. But that supply order block is against the dominant trend, correct? The trend is still upwards. This is now a supply order block, but it's against the dominant trend. All right, so here's the thing. Usually, continuation blocks, all the order blocks below, the continuation order blocks for all your previous demand areas have a higher chance of success because they are in line with the trend itself. Now, here's the thing. How do you gauge if we should still continue to use the continuation blocks in an uptrend so that when price comes down, you go and place a buy, or you determine that the price has now changed the direction from an uptrend to a downtrend? and it's time to enter on the supply order block instead, right? Go for the sell instead of going for the buy. So now, here's the thing. You want to determine the amount of bars that form the consolidation before that change of character. If let's say the range is not a lot, it's not a lot of bars, right? And that previous trend is a very strong uptrend, right? Especially maybe it's even a higher time frame, dominant uptrend, right? Big uptrend, small consolidation before the break downwards. This means what? This so-called downwards movement is or a reversal, but it's more likely it's going to be a retracement. It's likely to not last for long. So therefore, you still want to look to buy at the key demand blocks, all right? Not sell. But if this reversal has enough momentum to take down, let's say the trend that is not that strong, right? And then this reversal looks, there's enough range, enough bar in the range to break it down. That's where you can look to sell on the supply blocks instead of buying at the demand zones, right? And then you still would want to take your profits after selling, right, at all these demand order block zones. Good? All right, so now let's wrap it up. Running through and teaching you this, right? This is a heavy topic. It's not the easy, like ascending triangle topic that is so easy, right? But this is an important topic, and I'm glad you have gone so far. All right, so now let's wrap it up to see what we have covered so far. Not all supply and demand zones are order blocks, right? If you remember, that's what we say, right? Order blocks are special zones where the smart money makes all these major moves, and they must meet the 3 key criteria to be a valid order block. Number 1, inefficiency, right? We want to look for fair value gaps that signals imbalances that is caused by this large movement, the large orders. So in order for it to be a good valid order block, you want to see big bars, right? Or big movements, right? Signaling a big imbalance, right? Number 2, breakouts. The zone must lead to a clear structural break. You need to have a break of structure in the trend in order for it to be a valid order block. All right, this is easy, right? Number 3, liquidity. So there are going to be stop hands or liquidity grabs around all these zones area. So which is why there are demand zones which always have liquidity area and the key point of origin itself, which are the stronger zones itself. Next, how to mark order blocks on the chart. We can use the normal bar way, right? Use the last candle before the sharp move upwards or downwards, right? But if the subsequent candle has wicks, we can adjust for the wicks, right? From the wicks, right? And the third way is when the candle is so small, we will still use them. But in order for us to prevent false breakouts, we will add ATR indicator to expand the order block zone. All right. Next, we talk about the continuation, which is an uptrend and enter or retracement. Like always enter at the demand zones, which is easy what we talk about. But now versus a reversal order block. So continuation blocks follows the trend, right? And always tend to have a higher probability because we are riding in line with the trend. Demand zone works. Key order block areas are the most important areas. Now, next, reversal blocks goes against the trend, but they offer high risk to reward ratio. So that's where you want to use all the consolidation method, the momentum to validate the shift of the trend. Whether is this going to be a strong trend downwards or is this just going to be a retracement before you decide which order block to enter. Whether is it a supply order block or the demand order block itself. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.